We all hear it all the time. SoFi is a great company. That part is easy. The real question is, what should you actually pay for SoFi stock? How do you figure out fair value? What is reasonable? What is pure hype trash? And does that number change over time? Today I'm going to walk you through exactly how I think about valuing SoFi. No shortcuts, no gimmicks, just real fundamentals. If you appreciate straight answers and not hype, hit the like button, especially on educational videos like this. They don't usually perform well, but they matter the most if you want to become a better investor. First, what to avoid when valuing SoFi. Before you talk about fair value, you have to know what to ignore. When I hear certain things, I immediately tune out and move on. Not because people are bad actors, but because it has nothing to do with long-term investing. Here's what I ignore completely. Squeeze narratives and trading games. Extreme projections out to 2035 or 2040. Personal forecasts that ignore management guidance. Claims that valuation multiples don't matter. Or the opposite extreme, where people justify absurd multiples as normal. No serious long-term investor builds positions based on those things. Yes, stocks can trade at crazy valuations. No, that does not make those valuations reasonable. Hope is not a bull case. Hype is not a strategy. Valuing SoFi. Art, not science. Let's level set something important. Valuation is not a science. I wish it were. It would make life easier. There is no spreadsheet where you plug in a ticker and get a perfect answer, especially not with a younger growth company like SoFi. The math is easy. The assumptions are hard. That's why valuation is more art than science. The simple math behind SoFi valuation. Here's the framework I use. 1. Take management's future EPS guidance. 2. Multiply it by a forward earnings multiple. That's it. In SoFi's case, management has guided to roughly 80 cents in future EPS. Now comes the hard part. What multiple should the market assign? You could argue 20 times earnings, 30 times earnings, 40 times earnings, even 50 times earnings. And depending on that assumption, fair value ranges anywhere from about $16 to $40. That's a massive spread. And that's exactly why SoFi is difficult to value. Why experience matters with early growth stocks. With mature companies like Apple or Microsoft, valuation is easier. They have decades of history. SoFi does not. You're forced to compare it to other businesses, growth rates, margins, and long-term earnings potential. That's where experience matters. It's also why I avoided SoFi in 2021 when it was trading over $20, and why I was buying heavily when it fell into the $4 to $5 range. Same company, very different valuation. That judgment comes from practice, not formulas. Updated guidance changes everything. Here's another critical point. SoFi's current guidance is old. They've beaten and raised multiple times since then. That makes any valuation today incomplete. Updated guidance is coming, and when it does, fair value will shift, possibly by a lot. I don't guess earnings. I don't build valuations on rumors or spreadsheets pretending to be certainty. When management updates guidance, then I update valuation. Until then, flexibility matters. For some investors, a simple DCA approach makes the most sense while waiting. What management has already told us. One thing we do know, directly from earnings calls, 2026 and 2027 are expected to be the major earnings inflection years for SoFi. That matters. If you like the business today, management is telling you the best financial years are still ahead. That should factor into how aggressive or conservative you choose to be with valuation today. The most important key to valuation. Here's the part most people don't want to hear. There is no hack. There is no shortcut. There is no magic tool. The number one key to valuation is practice, over and over again. Think about it like this. Investing is a professional arena. You're competing against institutions with billions of dollars. Yet many people step into the market without practicing at all. No one would walk onto a professional golf course without hours of range time. But people will invest their family's future with zero preparation. That makes no sense. If you want to get better at valuation, you have to read financials, build assumptions, be wrong, adjust, repeat. That repetition is how intuition is built. Final thoughts. Valuing SoFi is not about finding one perfect number. It's about understanding ranges, risks, and assumptions. Stay grounded. Avoid hype. Let guidance drive valuation. And most importantly, keep practicing. That's how you stop overpaying. That's how you build conviction. And that's how you win long term. Thanks for watching. I'll see you in the next one.